If you own a business that operates in California, even if you are not physically located there, this is something you cannot afford to ignore. Have you ever opened a letter from the California Franchise Tax Board and immediately felt your stomach drop? A penalty notice, a demand for payment, a balance that seems to grow every month. And the worst part? You are not even sure how it started. California franchise tax penalties are not small, and they do not stay small. They accumulate, they compound, they become aggressive, and for many business owners, they come as a complete surprise. So today, I want to walk you through what is really happening behind these penalties, why so many businesses get caught off guard, and more importantly, what strategic solutions actually work. Let's begin with something most business owners misunderstand. California's franchise tax applies in more situations than people realize. You do not have to live in California. You do not have to have a physical office there. You do not even have to think you are actively operating there. If your business is registered in California, or if the state determines you are doing business there based on revenue or economic presence, franchise tax obligations may apply. And that includes the minimum franchise tax. For many entities, even if the business has little or no profit, there is still an annual minimum tax requirement. Now imagine this scenario. You form an LLC in California. You operate for a short period of time. Then the business slows down or stops. You assume everything is done, but you never formally dissolve the entity. From the state's perspective, the business still exists. The franchise tax continues. Penalties begin. Interest begins. And before you know it, the balance has multiplied. This is one of the most common situations we see. Now, let's move into penalties specifically. Penalties can arise from several issues: failure to file required returns, failure to pay the minimum franchise tax, underpayment of estimated taxes, late payments. And once penalties are assessed, interest is layered on top. The state does not wait for you to figure it out. The notices keep coming. But here is something important. Not every penalty is permanent. Many business owners assume that once the penalty is issued, that is the end of the story. It is not. There are strategic solutions available, but they require action. First, you must understand exactly why the penalty was assessed. Is it a non-filing issue? Is it related to estimated payments? Is the business still legally active in the state's records? Without clarity, you cannot fix the problem. This is where careful review becomes critical. Sometimes the issue is administrative. The entity was never properly dissolved. A form was missed. A payment was misapplied. Other times the issue is more complex. Multi-state businesses often trigger California filing requirements unintentionally due to economic nexus rules. Now let's talk about resolution strategies. One option may involve bringing the entity into compliance, filing missing returns, paying the required minimum taxes, then requesting penalty abatement based on reasonable cause. Reasonable cause is not automatic. It must be explained, documented, structured properly. Another potential solution, depending on the facts, may involve formally closing the entity and stopping future franchise tax accruals. But here is where timing matters. The longer penalties are ignored, the fewer options remain. Collection activity can escalate. Liens may be filed. Accounts may be levied. And once enforcement begins, resolution becomes more complicated. That is why early intervention is powerful. Some business owners believe that simply not generating income eliminates franchise tax obligations. In California, that is not necessarily true. The minimum franchise tax often applies regardless of profitability. That surprises many new entrepreneurs. So planning is essential. If you are forming an entity in California, you must factor in the annual minimum tax requirement from the beginning. If you are expanding operations into California from another state, you must understand how revenue thresholds and nexus rules may trigger obligations. Ignoring it does not make it disappear. Let's shift the conversation slightly. There is also a mindset issue here. Many business owners treat tax notices emotionally. They feel overwhelmed, frustrated, even embarrassed, so they delay responding. But the state does not operate emotionally. It operates procedurally. Every notice has a timeline. Every timeline has consequences. The faster you respond, the more flexibility you typically have. Now, what does a strategic approach look like? It starts with gathering all notices, reviewing entity status, confirming filing history, verifying payment records. Then it involves determining whether penalties qualify for abatement, whether installment arrangements are appropriate, or whether entity closure is necessary. Each case is different. There is no one-size-fits-all solution. For some businesses, the right move is compliance and correction. For others, it may involve negotiation. For others still, it may require restructuring operations to avoid future exposure. The key is not panic. The key is clarity. California franchise tax penalties can feel aggressive, and in many cases they are, but they are not unsolvable. What makes them dangerous is inaction. If you are receiving notices, do not ignore them. If you closed a business but never dissolved it formally, verify its status. If you operate across multiple states, review your nexus exposure carefully. The earlier you address the issue, the more options remain available. Let me summarize this clearly. California franchise tax penalties typically arise from non-filing, non-payment, or misunderstanding of entity obligations. They compound quickly. They can escalate into enforcement if ignored, but strategic solutions exist, including compliance correction, reasonable cause penalty abatement, structured payment plans, and proper entity dissolution. The difference between a manageable problem and a financial burden is usually timing. If you are unsure whether your business is exposed, it is worth reviewing now rather than waiting for a larger notice. Because once penalties accumulate for multiple years, the numbers become harder to absorb. If this video gave you clarity, subscribe to our channel. We share weekly insights designed for business owners and investors who want control, not surprises. And if you are dealing with California franchise tax penalties or want to proactively review your exposure, visit gavtax.com to learn more about strategic tax advisory support. Thank you for watching. I will see you in the next video.